Happy Friday, everyone, and welcome back to Your Finance TV. As is always the story on Fridays, we have Jay Poloski here from TPW Advisory. How are you, Jay?
Pretty good, Scott. The smoke is cleared, so we can breathe again.
Well, you mentioned smoke, and of course, your title was very easy to put together, especially those who don't really know what happened in the Northeast. We got a little bit of smoke from the fires up in Canada, and the title of your musings this week is "Where There's Smoke, There's Fire." Like, how did you come up with something as witty as that?
I mean, every once in a while, you got to take what the universe gives you, right? And yeah, this was an easy one. Actually, it came to me as I was biking to work on Wednesday morning, and was in early because I was on Bloomberg TV, that other network, Wednesday, and so I used that line, and it got a good laugh, and so okay, I might as well just use it again for the musings. But I think it applies not only to the very, hazy and strange and almost apocalyptic kind of environment we had in New York City on Wednesday and a little bit of Thursday, but I think it also applies to the markets, Scott, in the sense of, we wrote 3 to 4 weeks ago, we titled our musings Rotation, right? And we talked about a rotation we thought was going to occur from the big tech leadership to the cyclical sectors. And we talked about the barbell that we've been deploying here at TPW Advisory in our model portfolios for our US equity holdings. Big tech on one side, cyclical sectors on the other. And what's been clear is that that is starting to happen. So the smoke is starting to show that there is fire in the interest in the activity level of some of the cyclical sectors. So if you look at transports, for example, transports just broke above their 200-day moving average. If you look at the home builders, for example, they have just, broken out and are hitting new 52-week highs. The small caps, which has gotten, people have been bashing small caps. Everyone talking about the 8 stocks, the 7 stocks, the mega caps. Well, small caps, we use IJR, small caps just broke above their 200-day moving average. So there's some real action in the marketplace. And for us, that's really suggesting that, where there's smoke, there's fire applies both to the environment we've been dealing with in New York and throughout the Northeast, obviously, but also in terms of the markets. The rotation that we talked about is actually starting to fire. The smoke we saw a month ago is now manifesting itself in the marketplace.
Well, it's funny, not funny. It's like you've mentioned that it's all going to plan for you, what you've mentioned and what the story you've been telling over the last 6-12 months. What's interesting to you now? Like, what do you see going ahead?
Yeah, it is. That is, in fact, right. We've been constructive since last fall. Been pretty aggressive with that, very much out of consensus, very much of the view of our middle path that we're going to have what others call a soft landing. We think all that's starting to really manifest itself, and the Fed meeting next week will define that, right? Not only in the rate pause, which we expect will be permanent. We think by the June inflation report coming out in July that the inflation rate headline in the U.S. will be below 4%. So the Fed is done, and we believe effectively. More importantly, though, is the Fed is going to also update its 2023 and 2024 GDP forecasts. And we believe they're going to increase their forecasts, we think significantly, probably double or more what they have penciled in now, which is 0.4%. So maybe arguably a low bar, but nonetheless, that's going to be a kind of shot across the bow for the bears, the perma recession people, who I think are going to have to finally throw in the towel and that moves some of that cash, which, again, to point out something we say virtually every time we're on these videos, cash has been one of the worst performing assets year to date. So all those folks who recommended cash 6 months ago, 5 months ago, 4 months ago, 3 months ago, one of the worst performing assets year to date, some of that cash will be taken and reallocated to equities. And again, where there's smoke, there's fire. Today, the S&P is pushing hard up above 4,300, new bull market, all of which, as you say, is kind of to the playbook that we've laid out. What's interesting now is when we go through our model updates, as we did this week, we look at all the charts of all our holdings, all the relative indices, all the things we're thinking about adding, lots and lots of charts. And what's really struck me, particularly when I zoomed out and looked not just year to date or even over the past year, but looked at 2-year charts, 5-year charts, is how many things had huge runs up, in 2020, then the sell-off, right, in 2021. And then a year ago, or 15 months ago now, when the Fed started to raise rates, that was really the knockout blow for a lot of instruments that we look at. And so many charts, Scott, have basically been flatlining over the last year. And so now there's, I think, a lot of room to move higher from where we are. So that suggests to us that, this is not the end of the story, right? Arguably, again, if you look at the charts, a lot of things breaking back above their 200-day moving average, a lot of rotation starting to take place. The Fed is going to support the idea of a growing economy. They're going to refute the idea of a near-term recession. So there's earnings room to come. There's economic growth room to come. And the charts, when you look at them, suggest that there's a lot of room for various parts of the market to work higher. One example, the small caps we mentioned earlier, right? Large caps in the US trade roughly 19 times earnings. Small caps, 13 times earnings. There's tremendous room for some further upside. We look at some of the kind of future tech type of things that we employ in our thematic model. ARC FinTech, for example, ARC Genomics. These are back to levels that were pre-COVID levels. They're back to, ARC Genomics is back at the same price as it was priced in 2018. The difference, of course, being that we're 5 years forward. All these companies that make up these ETFs have been battle tested. They've been through the fire, so to speak, to keep pushing that analogy. And here we are again, just breaking out, just breaking above. ARC Genomics just broke above its 200-day moving average for the first time since June or July of 2021. So there's really interesting stuff going on in the marketplace.
Yeah, it's interesting. I saw there was an announcement today. Charlie Robertson, who is known in the emerging market space, was at Renaissance for a very long time. Has just gone to a fund, and he was doing a very big push on the emerging market side. You like the emerging market side too, right?
Well, it's interesting, right? Because we talked about 2 rotations when we wrote that piece, which we aptly titled Rotation, roughly a month ago. The first was the rotation from big tech to cyclicals in the US. The second, which we believe is already ongoing or underway, is the rotation from US equity leadership to rest of the world equity leadership, right? And so we've been highlighting that for some time. We were very bullish on Europe last year. Europe's up about 35% over the last year. It was the rabbit. It led the way for the rest of the world equity market. Now we have Japan, right? Japan is up 15, 16% year to date. It's one of our biggest overweights. When we wrote about the birth of the new in our monthly last week, we talked about the end of yield curve control in Japan, which we think is going to be very bullish for domestic allocations out of fixed income. Because what the yield curve control end means is that the Bank of Japan is no longer going to keep a lid on rates, right? They're going to lift the lid. Rates are going to go back up because inflation in Japan is running at 3 to 4%, wage gains at 3% plus this year, the biggest in 30 years, and yet their 10-year interest rate is at 40 basis points. So 3% inflation, 40 basis point on a 10-year. Yield curve control gets lifted, bonds are going to sell off, and folks are going to reallocate to equity. So one of our biggest overweights has been and continues to be Japan. But what's coming next is emerging markets, right? And again, where there's smoke, there's fire. So the smoke is looking at Latin America, right? Brazil and Mexico. We've talked about Mexico quite a bit this year. It's again one of our bigger equity positions. To us, it's the world's biggest winner of the regionalization of supply chains, right? As the Infrastructure Act, the Inflation Reduction Act, the CHIPS Act all drives production into the US. Mexico is a huge winner because it's included in the Americas through what used to be NAFTA. And so as folks come to the US and set up plants, battery plants, semi-fab plants, most of them in the Southwest, a lot of ancillary production is being set up in Mexico. So Mexico, a huge winner, stock market up 20%, one of the best performing currencies in the world. And now Brazil is coming right along behind it. I just looked before we got on the video here on the Zoom. Brazil's up 1.5% today. It's up 15, 20% year to date, even though 60% of the market is financials and commodities, which are neither have been, places where people have wanted to be. And so that to us is really interesting, suggesting that, maybe as the Fed, kind of suggests that rate hikes are over, the economy's not going to go into recession, we continue to think that means dollar weakness, and that means commodities can perform. And maybe Brazil is that smoke that's going to give you that hint that commodities are going to start to run as well. And so obviously, to finish up on the EM argument, though, for EM to really work, China has to work. And we've been constructive on China. That's one of the things that hasn't worked year to date. But we think the second half of the year is going to be a period of time where the economy in China will continue to do well. The year-over-year comps are easy, and the stock market, we think, should get a bid as the government continues to push policies that will drive the economy to domestic demand-driven growth. That's the big focus in China, away from exports, away from fixed asset investing to domestic demand growth. Household consumption, 38% of China GDP, 60 to 70% in the US and Europe. That's the big swing, and that's the opportunity that we see starting to emanate in China.
We touched on the Fed there before, and obviously we've got their decision next week. This week we've seen Australia and Canada surprised with their hikes. Do you think there's any sort of chance, or you adamant that it's just going to be unchanged?
Yeah, I think they're not going to raise rates. They've already signaled, right, that they're not going to raise rates in this go around next week, even after the strong jobs number last week, which was strong on the headline jobs, but was actually quite benign on the average hourly earnings, which is what the Fed really pays attention to, right? Their fear is a wage price spiral. Average hourly earnings last week were quite benign, suggesting again that that's not going to be a problem. And we just got a couple of data points over the last few days, one of which is the New York Fed's consumer survey expectations on inflation. That came in quite benign at right around 3%. And then you look at the 5-year break evens. What is the bond market telling you? 5-year break evens now have inflation 5 years forward at about 2.1%. It used to be last year was over 3.5%. So bond market has gotten much more relaxed about inflation risk. And I think those are the signals that the Fed's going to look at. And then, as I mentioned earlier, we think by the June inflation report, which will come out in July, but before the July Fed meeting, importantly, before, just like May's inflation number comes out the day before, the meeting next week. I think it comes out on Tuesday. Both of those are going to be very, very benign on a year-over-year basis, in large part because last year those numbers were quite high. I think the May 22 inflation number was 0.8. The June one was, I think, 1.2%. We're going to replace those with 0.3 or 0.4, which is what we've been averaging over the last 5 or 6 months. So that's going to drop the inflation number down dramatically. So no, we don't really worry about that. That's actually, I write in the Musing that that's an example of where there's smoke, right? Concern about is the Fed going to raise rate, but no fire because inflation is coming down considerably. And then there's one other that we should mention on that, where there's smoke, there's no fire. And this is really kind of, surprising to us here at TPW Advisory. And that is just the lack of interest in climate-related ETFs, even with all the headline news that flashed around the world about New York City air quality over the last couple of days. So climate has been kind of a frustrating area. As you know, we have a pretty big allocation in our TPW 20 thematic model. It's about 35% climate, so carbon, lithium miners, electric vehicle, wind, solar, nuclear, etc. We pretty much cover the gamut. And the space has not been a great space for really since COVID hit, and particularly since the Fed raised rates. But there again, the charts look pretty good because they've been flatlining for a year. And so one of the things we think is going to happen, and we're looking forward, is that we expect the stability that is coming forward, right? So we finished COVID, its inflation spike, the rate hikes that took care of the inflation spike, and now we're finally entering a period of stability. And I just note that the VIX under 15, I saw the guys at All Star Charts last Friday, when the VIX finally broke under 15, was the first trading day in over 800 trading days. So it's back to February of 2020 that the VIX was under 15. And the MOVE index for treasuries is back under 120, itself a very important level for the bond market. So we're starting to find that stability, right? Which we actually wrote about. Remember the title, or you don't remember, but I do. The title of our 2023 Outlook, which we published in October, was Stability Ahead. And we're starting to get that stability. And we think as we get that stability, coupled with the ever-growing information about the money being spent in the climate side of the Inflation Reduction Act, all the activity going on in the EV space, that those two things, demonstrated money being spent on climate plus stability, is going to give the climate names a little bit of a bid here as we go forward. So we're really focusing on a go-forward basis on that EM space we talked about. That's next. We've had Europe move, having Japan move now, EM coming up next. And then we've had big tech. We're now seeing the rotation into the cyclicals, even things like our fintech and genomics really starting to move. Climate is going to be next, together with commodities. So it's going to be interesting. We think both the renewable energy and fossil fuel energy should start to catch a bid here as we go through the second half of the year.
I do remember that show of the year ahead back in October. So my memory's not leaving me yet, Jay.
Well, I think it's interesting, right? That's 7 months ago, 8 months ago. We titled it Stability Ahead. And here we are in June with the VIX breaking under 15 for the first time since 2020. So I think for the viewers out there, it gives you a little bit of an idea that the folks here at TPW Advisory, where we really do focus forward, have a decent track record of focusing forward on the right things. That's all. Tried to sneak a little ad in there, and you wouldn't even let me do it. Gosh, come on.
I've let you do it twice now. All right, Jay, listen, thank you so much for your time. For all the viewers out there, go to Pulaski.com to sign up for his musings and to learn more about TPW advisory. Jay, you have a great weekend.
You too, buddy.
And for everyone else out there, good luck investing.